Ladies and gentlemen, we have just got some new shocking data to show exactly what is happening with US consumers, with US debt, and what's happening to people's bank accounts right now. While the media is out there saying that the economy is strong, consumer spending is strong, well, we have just got some new shocking data to show this is not the case at all. And I'll get into in a moment how this is really a recipe for disaster. So everyone, what's happening with people's debts, credit cards, and bank accounts? Let's not waste any time. Let's get straight into it. Look at this, everyone. Consumer debt in US surged by a record $40 billion in 1 month. And this figure is double what they were expecting. It says here, US consumer borrowing surged in November by the most on record, reflecting outsized increases in credit card balances and non-revolving loans. This is quite worrying, everyone. People are loading up on credit cards right when interest rates are about to go up. Also, what I think is happening is people got used to the stimulus and they got used to that extra money in their bank account, and so their spending habits changed. So maybe people got used to maybe going out more, spending a bit more, and now that that stimulus is going away, they don't really want to lose that lifestyle, so they're starting to load things up on credit cards. Not only this, but we saw a record amount of people quit in November, 4.5 million. So also people could be relying on credit to get them through while they're waiting on a next job or finding out what they want to do with their next venture. And this really shows that even though the headline unemployment rate is 3.9%, we all know that the data is manipulated and the unemployment rate, the real unemployment rate, is much higher. And I bring up a chart here. We can see balances balloon. US consumer borrowing costs post record increase on unprecedented credit card balances. So we can see the chart here, everyone. We can see it slowly declining. And look at this peak here. This is the biggest ever, and this is not good right when the Federal Reserve will most likely be lifting interest rates. We can also see change in revolving credit. This is like car loans, student loans, etc. That is almost at record levels. But listen to this warning on what's about to happen to people's savings and their financial cushion. Bloomberg economists estimate that household earnings less than $90,000 a year will have exhausted their financial cushions by February. This is not good, everyone. The reason why we've had such a boom in 2021 was because of all the stimulus, all the extra money. Not only that, people didn't have to pay their rent. People didn't have to pay their mortgages. But we're seeing with inflation, we're seeing with people leaving the workforce, the great resignation, we're seeing people's savings and finances are being dried up. And along with rising interest rates, with the financial markets looking like they're going down, this is going to lead us into a recession like Elon Musk is warning, like many others are warning, in the second half of 2022. And like I've shown you in a previous video, this was people's personal savings. We can see here they hit a peak in April 2020 when there was huge amounts of stimulus. But we can see now it has fallen all the way down to a savings rate of 6.9%. We are starting to now fall below the trend and fall below what it was before the pandemic and before the recession of 2020. But I've also got another indicator to show you what's really going on with US consumers and the economy. Look at this. This is the US Consumer Sentiment Survey. And we have to pay attention to this because if consumers aren't spending, companies aren't going to get revenue. And if they're not getting revenue, then that means stock market valuations have to come down. We can see here it hit a peak of over 100 in 2019 and 2020 before the recession. But then it rebounded to nearly 85 in 2021. But we can see now we've fallen back down to almost 2020 levels during the recession of 70. So everyone, what this simply means is people are loading up on credit to get by. People's savings are gone. Consumer sentiment is down. Inflation is absolutely destroying people's purchasing power, and they're having to use savings and credit to keep up with the increased cost of living. But people, like I said, this is a recipe for disaster. Because if the Federal Reserve does lift interest rates starting in March this year, with the debt so high, with inflation so high, like I've been warning and like many others are warning, this is going to lead to another recession. We can see the writing is on the wall, and we all have to start preparing right now. And the way I would prepare is, before investing, make sure you've paid off all your debt. Make sure you have an emergency fund. Make sure you have extra food, water, your own power source, so you can become less reliant on the system for when things really hit the fan. Because if you've got a credit card balance with anywhere between 10 and 20% interest, you got no business investing in the markets. And if you pay off that debt, well, then you're getting a guaranteed return of 10 or 20%, much higher than average returns in the markets, unless you're investing in doggy coins and meme stocks. And I hope you weren't loading up on credit card debt to invest in those either. So everyone, I thought this was very important to let you know what's really going on. That was a quick update with what's going on with the debt, with what's going on with people's savings account, and what's going on in the real economy with consumer sentiment. But what do you think about this? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you in the next video.